So I'll call the meeting, the Joint Retirement Investment Board meeting to order. And we'll get to the agenda. First item on the agenda is to approve the minutes from July 22nd, 2020. Somebody want to move to do so?
I'll make a motion to approve those. It's Ken.
Eric Caliper, I'll second the motion.
Excellent. All in favor?
Aye.
Aye.
Aye. Any opposed? Abstentions? Hearing none, so moved. Thank you, everyone. There's got to be a better way to do that too, remotely. Next item is Carolyn, the actuary RFP. Is Caitlin on?
Sure. Yeah, so just so an update on that, it's in process. We've got kind of an initial working draft. The discussion around the timing of the RFP made the most sense to kind of to think about having that go live at the end of December, first week of January. And the reason is there's a large balance of deliverables from the current actuary into the town over the next, say, 6 weeks. And so we wanted a clean slate. But I think at the next pension meeting, you will have a really good kind of final draft of what the RFP will look like, and we'll submit that around and ask for comments and questions back.
What exactly are those deliverables?
Driving the car here, I can't refer to my notes. You'll have to ask Caitlin, but it is, my understanding, if I recall, it's foundational stuff to feed for the budget process. And
right, which is kind of how we got here. Kind of how we got here in the first place, and I really don't want them part of our foundational element for next year's budget analysis. Sort of the whole reason we're going through this. And that's the whole reason we wanted to get the RFP up and moving. So I don't know how everyone else feels about it, but I honestly have no interest whatsoever in the current actuary having anything to do with the budget process.
I think
Am I
that's
talking?
something we incorporate.
Maybe I'm talking in a vacuum. Maybe everybody else is worried with it, but my memory serves me that it was a very painful experience a few months ago.
No, I agree, Brian.
Yeah, Eric Caliper here. I agree also. I mean, I know this is probably going to be a look back to the July 1 numbers, but what concerns me was also I heard that the town had made an offer to some town employees for early retirement. And if that was captured, and obviously this won't be captured in this actuary fund, that's something that the pension board should at least be made aware of when an offer like that gets made to the town employees. That's something that this board should know about because that affects the actuaries moving forward.
So should the Board of Finance, because it's going to impact the liability stream. And that's it has ramifications several different ways.
But Brian, I do agree. I mean, I think the position that we were put in by the actuary in the spring was just not proper, and I would, I think that justifies why we're doing this now, and I wholeheartedly agree.
Furthermore, as I've tried to explain, this isn't a esoteric, unique RFP. There are, at least 5 to 10 completely outstanding, well-established actuarial firms with with great credentials that could all do this work in short order, I might add. So I don't see how it's a difficult RFP or sort of an onus on the town and this board to kind of select somebody from the list. So the town's inability to get an RFP done quickly. I mean, I don't know who we have to raise the flag. I don't know who we have to raise the flag to, but
I was able to get an agreement of a date for a draft, and I've been calling. I've been talking with them every 3 to 4 weeks and laying an email saying, where are we with the process? So we have a date. I'm not going to make excuses for the town, right? It's their responsibility to help submit this RFP. We have agreed upon date, and I'm in the process of, reminding them that deadline's getting closer and asking for the draft. So I don't know what to tell you, other than we have a date. They have to meet the deadline.
And what is that deadline? You remember? Oh, you're driving? Well, I would put it this way. I would, if they need any kind of, urging, or you don't quite see the immediacy of your deadline and the request and getting this done, I don't think there's a high probability of this board approving anything that's produced by the old actuary. So if they maybe have that information, they might hustle along and get us in the process to look at a new actuary. And that would be kind of the nicest way I could put it. So it's in their own best interest, I think.
Wouldn't they have been getting new actuaries, RFPs every couple years as a good practice? So you take the previous RFP, you make your updates. It's not much is changing in the field of actuary, and put it out there. It doesn't take that long. If we're looking for a specific thing, that it might take a little time, but there's nothing specific. There are a bunch of actuaries out there. They all do the work for all the various pension plans, both corporate and private. So it's like you're trying to get one little niche one. It should be pretty easy to update. This is Eric.
So Eric, would you like to join me on this effort to try to get this RFP actually written and completed? You have experience in that. This is my first go round with an RFP for an actuary. But if you have, you have that experience, that'd be super helpful.
Yeah, I'll join you. I haven't done it the actuaries, but I've been on other RFP committees. So, and from, so. It's really, it should be driven by the purchasing, right? The purchasing manager should be driving this, and as well as the administration.
I literally found examples on the web that looked pretty much fine to me, except that we had to change like addresses and stuff like that. I mean, I found one for the state of Connecticut, which obviously was above and beyond what we would need, because it did have a lot of different requirements. But I mean, there are other examples out there. This is not, we need standard municipality in the United States actuarial services to, review and calculate four trusts. Is our OPEB split? I mean, it's like three or four trusts. It's not, that's about all you have to specify to any decent actuary. And like you said, an actuary, to maintain their credentials, they have to be abreast of all the GASB standards and actuarial nuances, or else they wouldn't be in business. And they have other clients. So this is not, to me, this is just feet dragging, quite honestly, or ineptitude. So I don't know, they can pick which one of those two they want, but I think the feedback should, and it's a shame that no one from the town, I guess, is on our meeting tonight. Because,
I have Caitlin on my, I have Caitlin messaging me as I try and get her on.
Ah. That would be good.
I mean,
Is Vanguard on as well?
I think so. Brian was on before.
Okay, I just wanted to make sure that.
I no longer see an image of Brian, but it seemed to me he was on earlier.
Brian Scott's here. I see Brian Binkley's image or his icon. I can check to make sure he's still connected.
No, I I'm not in front of the computer. I just wanted to make sure that we weren't going to have to be chasing down our OCIO consultant for the next part of the meeting.
No, I'm here. Sorry, I was on mute.
Yeah, damn mute button.
Well, that happens every time, doesn't it?
Either you wish people knew where that mute button was, or it's just like it's never it's always working against you.
Yeah. It's
And
not the
Cheryl,
phone,
you said
it's the
you're trying to
computer.
get who's trying to get Caitlin on? Is it was that
Chris.
Was that Chris or was it? And seems to be so it's not just our board that has trouble getting using the WebEx. It's good to know.
It's my first time hosting. It's not going well, huh? Well, Dave Kelly's unavailable, so you.
I apologize to everybody. Look at that. I'm on.
Saying about high tech?
Exactly. Well, since there's not a vote involved, we could just come back and clarify this for Caitlin if hopefully when she gets on. Our next item on the agenda is the Vanguard performance reviews, which I hope that everybody get those.
Yes.
They were on Chris's email. Excellent. So Mr. Binkley, you want to take it away? You're on mute.
There we go. I was running a little slow. Hi, everyone. Good evening. Good to see those I can see, and good to be with you again. So it's myself and my colleague, Brian Scott, both on the phone from Vanguard. And, we've had last month off. So the last time we convened was July 22nd. We reviewed everything through the end of the fiscal year. And so what we have today is performance. We'll review that the first 2 months of the fiscal year. And as far as the presentation, the other sections besides performance is we broke it out, including we did some analysis using our updated capital market assumptions to look at the expected rate of return over a 30-year period under different allocations. So I think we'll spend some time there. We also did include some private equity pacing. We've talked about that at length in the past meetings. We didn't put a lot of content there, but we just did want to talk to it in the context, even if we don't make a decision, how private equity will roll down over time. And then we have the market outlook section. So with that, I don't have any ask of the committee. Doesn't mean you won't have any of me. What I would like to get feedback as we get further into the presentation is if you all have discussed anything further on private equity. since we've discussed that, and if we should, there's something that's missing, or if we should table that for a future discussion. Again, it's a long-term decision. I respect that, and no problems being patient, but I'd like to get some feedback. So with that, I'm going to start telling you where I am in the presentations. If I go too fast, if I don't cover something that you wanted me to, jump right in, and we'll take it from there.
Hey, Brian, perhaps you could share your screen as you take us through the deck.
Oh, Ken, you're really testing me.
You know, there's a little icon down at the bottom that says share. If you click on it, it gives you an option of which screen to share or all of them on your laptop.
Yeah, of course. I've got quite a few up.
And Brian, this is Ken. That wasn't me because I wouldn't even know how to ask that question.
Okay. There was that.
Just to let you know.
Okay. Let's see.
It's that IBM guy.
Sorry.
Y'all see the page where I have up on with performance?
Looks good.
All right. Okay. So since we last met, the markets have been friendly to returns. Stocks have been, continue to be up in July and August. We've given some back here in September, but this report is through August. I don't have fiscal year-to-date numbers just on the market, but looking at the numbers here, calendar year through August, U.S. stocks have been the leader, up over 9%. Non-U.S. stocks have continued to lag. You see they're down almost 3% on the year. Quick comment on that.
Hey, Brian, I'm sorry Brian, I'm terribly sorry to interrupt. I'm not on the WebEx. Could you just tell us what page you're on? Yeah. Okay. Yeah. Thank you.
Page 4. Page 4 for those not on the WebEx. There are questions about, why international has been lagging. And really, if you look at the sector composition, which is not here, the U.S. favors and has a higher allocation to tech stocks or the IT sector. And I'm sure many of you have read, the companies like Amazon, Google, Facebook, they've just been on a tear, and that's really been driving the performance in the U.S. market. It's kind of been narrow as far as the leadership. So just that was a brief comment on there's some big sector weightings between U.S. and non-U.S., and that's just been driving some of the disparity. In the center column, looking at bonds, as rates have fallen this year, I'll show you that. I mean, it's an inverse relationship, so bond prices have done well and performance has done well. The other just big word in the market is just this disparity. I talked a little about the U.S. versus non-U.S., but even if you look at how large cap is done versus small cap, you see a wide disparity of return. And again, those big large cap tech companies have been driving the larger side of the market. And we know some smaller companies have been suffering during this COVID. And you see the big disparity between growth up 42%. This is a 1 year, while value stocks down 9%. And that's one reason why we practice and why the town's allocated. We own the entire market through those two equity funds that we have in the portfolio, the total stock market index, the total international stock. So we're not trying to time, which way the market is going. Page 6, just a moment on here just to see how big that disparity of returns has been. You see on the far left, tech stocks on a 1 year basis up over 54%. Energy has been really weak during that period, down 33%. So what a huge disparity that's been. And then the next page I'm flipping to is fixed income. I talked about what the fixed income is right now. I don't have to go into all the different segments of it, but if there was a story here is the safest parts of the bond market have done well. Treasuries, investment grade corporate has come back since the downdraft in March, but still lags treasuries and high yield corporates we don't have in the portfolio are also lagging.
So yeah, that's and I asked this before, I'm sorry, but so Vanguard doesn't have a Core Plus offering that's indexed or anything like that, or so in other words, we used to have Core Plus,
we don't have a Core
which has
Plus
generally been
offering.
worth.
Go ahead, Ryan.
So we're missing, you know, I think historically Core Plus, and for those who are speaking Greek, because we haven't talked about fixed income in a while, Core Plus just means the old Lehman aggregate, which is now the Barclays aggregate bond index, which is what was on that last page, plus the ability to add. I think on Core Plus you're allowed to add emerging markets and definitely high yield or junk bonds, which
yes,
Sykes, which was our provider, not that they were large players or taker of risk. I mean, it's to have that ability and flexibility is
right.
You generally pick up basis points over the ag itself on a long-term basis, and we don't have that exposure anymore.
We don't have that exposure. That's correct. And just a little background on how we look at that is we certainly look at, so the index fund, that the core fixed income fund that you're in, there's no high yield in there. Vanguard has an active core fund, but not a Core Plus. I think what drives that is just our philosophy around high yield. We do have high yield funds on a standalone basis, but high yield we would classify into the return seeking component of an asset allocation. And so the fundamental piece that we want bonds to hold within the portfolio is to protect in the down markets. And that's why we hold the core, just the core without the high yield. We went back in time to March, high yield was down double digits, and it certainly didn't protect any pension plan or any investor in a down market. So that's how we look at high yield, versus the other parts of the fixed income. We want your fixed income to be the ballast in the down markets. And if we were ever to add high yield, we would take that or source that from the equity, or what we refer to as the return seeking part of the portfolio.
Okay.
But there's no exposure to high yield in the portfolio since 6:30. This last page here on 8, this is the last slide on just the overall markets. This is showing the yield curve, and just what are yields across different maturities for fixed income. And you see a year ago, at least we were getting something in fixed income, depending on where you are on the yield curve. And since coronavirus, we're close to, as you all know, zero bound. The Fed has not shown any expectations to raise rates in the next couple of years. And the reason I show this is this impacts, forward-looking estimates of return, because our return expectations have come down for fixed income due to we're at historically low rates. I'll speak to that more in just a moment. Flipping to page 9, just showing the performance of the both plans. Right here we have the pension. I'll focus on the fiscal year to date in the last 2 months since we spoke. As I mentioned, strong absolute returns up 5.9%. It is lagging the benchmark target. That really has to do with some fair value pricing in the equity markets and some pricing discrepancies in the fixed income market, but those wash over time because the big question is how are my index funds lagging? And I can get into that if there's other questions. As far as the current allocation, you see here where we are current versus our policy and the difference. We're very close to our policy targets. Yeah.
Hey, I would, since we're on that, I would like an explanation of the deviation from the target.
Yeah, I'll show that on the next page, Brian. You could see some of the fund returns, and I'll jump in on that.
Excellent.
Here, just showing that we're close to targets. We have cash flows happening every month, and we use those cash flows to rebalance to the targets. We did have a big contribution to the plan in August, and we also used that to go back to our targets. The big thing here I just want to highlight, and this has been past discussions, is you see the hedge fund allocation at 5%. You know, several months ago, we did put in instructions to redeem for Wellington, and they just had a lag, you know, a lockup period. So as of 9/30 at the end of this month, that redemption will be taking place. That redemption happens over two parts. They make 90% of that allocation of this 21 million available about 4 or 5 days after the end of the quarter. And then we have to wait for the remaining 10% of that hedge fund allocation from Wellington to come to us by the end of October. So this will be the last month that you'll see here the hedge fund allocation, or excuse me, through the end of September. Let me address Brian's question on page 10. So talking about, you know, we have the portfolio a little bit behind pension target. Where that jumps out the most is that if you look at the total international stock index at 8.55%, that's behind the benchmark return of 9.19. And what this tends to happen over time is there's a thing that's not unique to Vanguard. It's called fair value pricing. In international markets, they're closing all throughout the day, and the index providers are usually capturing that price. So, you know, if China closes at 8 a.m., that's reflected in the benchmark. But Vanguard and other fund companies, if there's news that happens after the close of international markets, we reflect that into the valuation of the securities in the fund. And so there can be a lag on any quarter or any month. As you look farther out, it usually smooths out over time or even after a particular month. So the index funds track very closely to the benchmarks over time. So as far as explaining the disparity in the fiscal year-to-date performance. Yep.
Hey, Brian, can I interrupt a follow-up question? So that would imply that we'd be more likely to see the index fund lag the benchmark rather than outperform the benchmark, right?
It just depends on the time period. So you typically see that reverse the next month. I mean, the index fund will always lag the benchmark because of fees. In this case, you know, the fees for the international stock index are about 7 basis points. So it'll typically lag by about 7 basis points, but not even that, because there's another thing that index funds do, which is called securities lending, and it's the way to add some return. So we can certainly provide attribution, even at an index level, of what's causing the disparity, if it's fair value pricing, if it's securities lending. But Carolyn, yes, it could lag on a particular month or quarter, and it could even, you could see an index fund outperforming its benchmark as well. You know.
Okay, and then if it's securities lending, just curious for you, like, do you have any caps, any kind of what percentage of the index fund positions you'll allow? You know, you will lend out for securities lending? Do you have hypothecation levels for each of these funds?
Yes, it's very conservative. I don't have those numbers offhand, but we do have several pieces on the securities lending that we do. It's a very conservative program. You know, we're not really in any of the lending that we do or the funds do, returns that money, I think the number is like 90% to the fund. A lot of fund companies will keep a split of that securities lending that they get. It's a way to make money for the company.
That was going to be my next question.
Right.
Yeah.
Compared to the industry,
That was my next question,
we can, yeah, we can see a lot of that data versus Fidelity or BlackRock or State Street. And compared to the industry, we return the highest portion of capital received from securities lending. And I will be glad to, forward some pieces on that, either after the meeting or, to discuss at a future meeting.
Brian, do you
Is there
anticipate?
anything else, Carolyn?
No, I'm done. Thank you. That's thank you.
Brian, quickly,
I heard
do you
another question.
anticipate this shortfall to level out by year end? I mean, as you said, we can see the index is 9.19 and performance 8.55.
Right.
Okay,
Right.
so
Yeah, you could expect that to level out. Yes. The disparities can happen at the end of any month end or quarter end, but over time, then yes, you do see that smooth out. So I would not expect to see that gap as large it is right now, is at about 60 basis points.
yeah.
Yeah,
Okay.
that's pretty wide. I wouldn't expect it to stay, that gap to stay as we roll forward in the year.
All right, so
You see these gaps a little bit more frequently when you're in very volatile markets, right? Because
Sure.
of your pricing. So you tend to see that disparity happen a little bit more and more in volatile markets.
I just want to make sure we got Tom's question correct. Are you talking about the overall pension or just in the equity stuff?
I'm just talking about the Equity International, which we were on. That Brian pointed out. This is obviously jumps out as a fairly large delta relative to everything else, and I'm not as experienced as everyone else on the call, so I just want to get some perspective as to how concerned I need be here because of this shortfall. And if it's going to level out over time, if we think this is just, a blip or an anomaly based on, as we're seeing, as Brian pointed out, volatility, which is in some way, shape, or form attributed to COVID, then I guess I'm not concerned. But I just want to ask.
No, I expect that to be the case, Tom.
Yeah, and I'll also just put out that 60 basis points, I'm not going to belittle it, but we just add active managers, and particularly in those markets and in smaller emerging markets, we would see outperformance of 200, 300 basis points. And occasionally, the flip side, they're very volatile markets, and if you're based on country selection and stuff, you could see managers all over the place. So I'm like, I do understand global closing markets and a benchmark that closes in the local market. So I get all that. I was wondering if Tom was asking to the top line where you see total pension target, and Town of Fairfield pension, and that's a much bigger delta. We're trailing 200 and something basis points, and that, well, that's still the after effects of Allianz. So that one's not going to close until
these won't close.
Knock on wood, hope we get maybe a legal settlement.
Yeah, I would expect more on the short term, right? Because anything, for the most part, anything in the 1 year numbers, that's got a lot of the active management results in there. But as it relates to, since 6/30 when we made all the changes, I expect this tracking error to come down quite a bit, Tom. And for the fund as well. Absolutely.
So you can kind of say there's 100 basis points worth of tracking error. We can see, and then the rest I would attribute to basically Allianz. So another 150 basis points.
Okay.
Which coincidentally conforms to what I said to Board of Finance on last Tuesday, or Wednesday, or whatever night that was.
Yeah, and just moving. Sorry, should I move on or should more questions?
To tell you, Caitlin is on by phone now. Caitlin, are you there?
Yeah, I'm here now. Sorry about that.
There we go. Okay. Sorry to interrupt. I just wanted to make you know.
Sure.
Thank you.
Caitlin, if you do have the presentation, we're on page 10. I'm sharing my screen as well, but yeah. We can come back to on the hedge fund. This is the Wellington. I could show it on the next page. This is just the 2 months. The 2 months. It has the outperformance over its benchmark. It's continued to lag versus the public markets. I know that's not its benchmark, but this is the redemption that will be happening at the end of the quarter. The private equity in the real estate, there's zero values. We don't get those until the end of the quarter, and then even then it's a lag. So I don't have any updates specifically to the private equity or to the real estate specifically with regards to performance. If we turn to the OPEB, some of the same story. You have better absolute returns here on the OPEB portfolio. If we're looking at the fiscal year to date of 8.5, that corresponds to the 5.9. We have a higher risk tolerance here, right? This portfolio is more 70-30. While it doesn't figure into the fiscal year to date, we also have a 10% allocation to real estate versus the other portfolio is just 5. But really the biggest difference that's driving the absolute returns between the two is the heavier weight to equities, especially U.S. equities, which have done quite well, and which we covered. The OPEB plan, really has been indexed for quite some time. It's the same funds. I will point out for the international stock institutional, we were able to, because of the pension plan, get this plan, the OPEB plan, into a lower share class when we aggregate all of the assets. So, it brings it down a couple basis points. So we look at the entire relationship. I just wanted to point that out. We haven't adjusted, active management here on the OPEB. Maybe we do that at a future meeting, but we do have the PIMCO Global Ag Fund here. PIMCO was lagging its benchmark really until the last 2 months on a year-to-date basis, but the last 2 months, as the credit markets have improved, you've seen them outperform here in the 2-month period, even on a 1-year period now. So with that, not much other comments on the OPEB plan.
And they made up a lot of ground. They were trailing by at least 150 basis points. That's quite the
even
turnaround.
Even more,
I guess the past 3 months. I guess is when they.
Yeah, and when I looked at PIMCO through the end of June 30th, they were lagging by a good degree. So it's just that improvement in the credit markets. It's a place where they play strongly and help them dramatically. Yeah, you could see that, Brian. Any questions on the OPEB plan? Okay, we can come back to it if anyone does see something want me to go back. I'm glad to do that. So I'm on page 15 now. What we prepared here on page 15 is looking at your asset allocation, and what I will point out on here, what I have reflected as current policy. I'm doing this post the liquidation of Wellington, so that 5% of allocated to U.S. equity and non-U.S. equity for purposes of forward forecast. This is looking at a 30-year time horizon at our capital market assumptions for each of these asset classes. Our median expected return over that 30 years would be that 6.48%. Now, Vanguard always wants and encourages plan sponsors to look at a distribution of returns. not just 1 point. It's very rare that you'll, land right on top of the midpoint. And so we focus kind of on this distribution of the 25th to the 75th percentile. And, my observation would be, Hooker and Holcomb would have to, or a future actuary would have to weigh in, but really is the 7% return target, would fall, within that range. And so I would say that an actuary could, still approve that as a 7% return target and be comfortable with that. It's within basically 50 basis points, but I'll let them opine on that at a future date. So one, I wanted to show the range of returns there, and then look at this expectation with different allocations. And these allocations are nothing new that these are allocations that we've talked about really since we were even hired, even back in January, where we could increase real estate up to 10% of the portfolio from its current allocation of 5. Certainly we would be comfortable with that. Flip side is, holding real estate and then just increasing private equity to 10%. We've talked about that in the past. And then really what would that allocation look at if we increase both of those alternatives to 10% of the portfolio? And you could see how that range of distribution increases as we add, I'll call it, more risk to the portfolio. What I will say is, when we're doing this analysis, it's like, wow, I would expect a higher expected return for increasing private equity over real estate, but it's really where you fund it from. And so given what I talked about with fixed income, how low those expected returns are for fixed income going forward, by increasing the allocation to 10% from real estate, since we source that from fixed income, it's just a bigger disparity of returns than if we expect of private equity over the public markets. So I wanted to provide that as context. What I will say, the trend for any public plan, that probably goes the same for corporates, is plans have been reducing their expected return given the strength of the market the last 10 years and where valuations are and where fixed income markets are. Are those a mouthful? There's a lot of data. I'm going to kind of pause for thoughts or questions, and there's still a couple of other slides to cover in this section.
Thoughts out there? I have some, but let other people speak.
Mm-hmm.
Hey, Brian, I was just wondering, are those returns stated gross or net?
Yeah, good question. I've gotten this question before. This would just be gross. Yeah, so you'd have to incorporate any fees from the plan. Yes, this would be gross. We're not taking or backing out any fees.
Good question. I'll just point out that before.
Mm-hmm.
Go ahead.
No, I was just going to ask Brian and Brian V. Oh, that's horrible. Brian Vanguard. Would you? I mean, obviously, Vanguard's a low fee shop, and we're trying our best to keep our fees as low as possible. But we're in certain higher fee products.
Right.
Do you have a guesstimate? In other words, because that was a great question. I'm sorry, I don't know who asked it, but it was a terrific question. We're looking here at these, mid 6% median expected returns.
Right.
Do you have a guesstimate as to how much we should shave off of that to represent the fees if you blend it out between the index low fee stuff and then the hedge fund, private equity, real estate, et cetera, high fee stuff?
Mm-hmm. I can't do the mental math. I don't know if Brian is quicker on the draw there as far as we could provide that estimate, Ken. I'm trying to to best the ballpark.
Yeah, and I wasn't trying to
Just
do
single
a
digits.
gotcha.
Single digits as far as basis points.
Mhm. You think
Yeah,
so?
It's
Even
probably about
yeah.
it's probably about 5 basis points for the non-alternatives,
Right.
and then in the alternatives,
Right.
it's probably as much as 10. So
Yeah.
I think
Yeah, private
so.
real
So
estate's about
you could-
110 basis points. Private equity's more, but as far as the U.S. equity, non-U.S.
other,
equity, U.S. big sense. Go ahead.
The other interesting thing is
Mhm.
like I think where these you did a 30-year time horizon. Did your when forming your estimates going forward, were those just spot estimates, or did you use some sort of a historical? Oh, can you show me that?
Yeah, we, you know,
There you go.
it is a Monte Carlo simulation. So we're looking at, you know, here are the expected returns for each of the asset classes in the portfolio. So we have that. Then you're looking at the correlations of those returns. You run that through a simulation of 10,000 simulations. And then you get, going back to this page, a range of returns and a point. But we're looking at all
so, I mean,
different,
it
10,000
begs-
different combinations.
Right, and then we have two specific areas of active management in private real estate and in private equity. And granted, we're not in HarborVest. You know, we're going to be in HarborVest, but we appear, knock on wood, to have been in an upper. I think Lexington's upper decile. If not decile, then they're like the upper 15% of the overall marketplace. So
Right.
you yourself said in your HarborVest presentation and stuff how there's massive disparity in private equity returns. Like, you know, the difference
That's
from
right.
being in the. I apologize, my dog she wants to vote on something. So I don't know when they put together this. You know, I'm sure they're using an amalgam of like all real estate, private real estate, and all private equity, which has, you know, a large bandwidth. I'm just kind of, how did it? Is there any like tilting or shaving or saying, hey, we're assuming you guys are going to be in the even in the upper half, right? Saying that you're going to be, you know, we're going to say, which, you know, we all believe we're the top 50%, right? But
Right.
I'm just trying to put my arm out because it can make quite a difference.
Yeah, we don't make any alpha expectations above the asset class. So that's a reason why any plan would or does include active management, is because they may have a return target. Maybe it's hard to get there, and you can do that through, or hopefully do that through, active management, though the results don't show that. And S&P just released their latest report. But it doesn't, as it relates to the model, it doesn't make any alpha expectations for active management, and that would also go for private equity. So it's more of a historical return. For private equity, it's been about 250, 300 basis points over the public markets. But yes, you get a top performer like some of your existing private equity has been, or HarborVest, there could be even returns in excess of that. So yes, I went back to the performance report to show your private equity. So looking at a 5-year time frame, you could see it would return 14%. And, you know, that's about 500 basis points over, you know, the domestic. Well, you did have some
even
equity,
even
but
even
just
the
looking at the Russell.
Yeah, and even looking at our 10-year performance in that one Lex, our longest dated Lexington thing, it's like 200 and something basis points over the Russell plus 300.
Mm-hmm.
So I mean,
right.
Just food for thought for everyone in the audience. So I mean, I know the fees could be 10 to 15 basis points, but then there's no alpha expectations in these numbers either. And my
Can I,
major
go ahead.
my only other observation is that so pre-Vanguard, the way I always I try and think of the market or the portfolio is obviously equity and debt, you know, is for sort of stability and preservation of capital, and so that kind of diversification. But then I also bifurcated into public and private sort of exposure, if you will.
Mm-hmm.
And when I say private, you're starting to get into, I would just call it alternatives. So you throw hedge funds in there, even though it's like equity exposure, long, short, and it could, you know, it had non-correlated features, yada, 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 private equity, whatever, we're selling liquidity, so getting some lift there. Real estate, you know, it's got fixed income characteristics, but, you know, it's, you're getting the credit risk that's embedded there. But anyway, well, our portfolio like, where we totally like shook the blanket pretty well here, and this is falling out now. We're active, now we're passive. The way it used to be, it was 60-40, but I would say that, as a matter of fact, I'm almost, I can go back and look at the numbers. 20% of that was alternatives. So you basically had a 60-40, which is add up to 100, but then you could say it was like 80-20 publics versus alternatives, because, you know, we had currency exposure, we had the MAC exposure, hedge fund, and private equity and real estate. You'd add them up, and I actually think they might have been a little bit more than 20%. So when I look at these A, B, C, Ds, actually the closest to where we sat before, with kind of, I'll say, the alternatives exposure versus, you know, mainstream. And I would say if you're going to do that stuff, you better have long-term horizon and be a seller of liquidity, which I think we are still based on our liability profile. Then D is really the closest to that, because you essentially have 10 and 10. You know, real estate is 10, and I would, you know, so on the alternatives, if you have 10 real estate and you have 10 private equity. Just so just how I see it.
That's exactly right. And just to remind the whole committee, and that's how we were framing it up when even pre being awarded the contract, is your total alternatives exposure was over 20%. You know, included 2 different hedge funds, included commodities, and where our best thinking or our recommendation was, you know, hedge funds are kind of somewhere in between. You don't get the full return from those as you get from the equity markets. You can even see that in this report. Commodities, very volatile. You only have 3%. It was really hard for that to move the dial. So our initial recommendation was, because you have the long time horizon, and because you know, so let me pause there. Because you have the long time horizon, you have the ability to increase the alternatives, the private equity to 10% and the real estate for 10%. So we look at those as more attractive asset classes than the hedge funds and the commodities. And that was the basis for recommending the liquidation around hedge funds and commodities. Private equity, if we did go to 10%, the other 90% of your portfolio is liquid. So we don't have to worry really of any liquidity constraints in this portfolio. Real estate, somewhere in between, we have quarterly liquidity. So I don't really think of that as a long-term lockup because there's quarterly liquidity. So that was the basis for saying, if you've got a 30-year time horizon, you can be patient with capital, increase your exposure to private equity, because historically that has provided better returns over the public markets. We've talked about HarborVest. And then with real estate, you know, look to increase that. Our expectations over the fixed income markets are higher. And there must have been some discussion with your OPEB plan about this as well, as you have a 10% allocation to real estate in your OPEB plan. And again, we have quarterly liquidity, but it's been a very good diversifier for plans is the private real estate.
Really, just so you know the history behind OPEB, our full intent was to eventually mimic to the best of our ability, the same IPS and allocation in all the plans.
Right.
We were just limited because of size. So
Right.
that's why real estate, we got over the threshold, or maybe principal just let us, because of the combined exposure, have that thing. So we had we gone another, we're 57 million now. I think once it got to 100 million, I think we would have seen some other alternatives and stuff go in there, just sort of to get the reduce the public equity volatility. That's why we ran a bunch of those alternatives, folks. It was more give up some of the return, and in return you knock down some of the volatility in the returns.
So I would actually, getting there in two different ways, Brian, but I agree the far right is kind of where we were as far as an initial recommendation. There's lots of things to consider, and we've talked about in previous meetings, primarily with private equity. We haven't dug into private real estate a lot, but with private equity is the lockup, the higher fees, but the returns, and even with your history in Lexington and Mesro, it's worked out for the plan.
Brian, can I?
Yeah.
Oh, go ahead. No, I just want, excuse me. It's Ken. Can I just raise an obvious but I think important thing to you and the rest of the board that I think is something of not for tonight's business by any means, but when the town talks to us about the discount rate that we use, it's usually expressed to us that it's quote unquote not our business, so to speak. It's a Board of Finance problem or a town problem in terms of funding. But I actually don't agree with that on a range of levels. One is we have a fiduciary responsibility as a board to set the discount rate, I believe. And two, what I'm concerned about, and again, this is to the whole board and you, is I'm looking at your return, your median and so forth expectations. And I actually took a quick peek ahead at, the crosstabs that give break it down by the different categories and different asset classes. And I would argue, I think some of it is quite optimistic personally. So what we're at risk is as a group is being put under pressure to try and achieve a return. And I don't know what your philosophy is or how other boards view this, but I think, and I'm talking for myself when I'm even looking at how I do my own investing, I believe the worst possible way you can invest is to try to come up with a return you're trying to achieve and then try to figure out some way to get it. I think that the right way to invest, and I think we've done a pretty good job, is to look at the investment landscape, come up with a diversified portfolio that we think matches the risk profile and so forth that we want to take for our pension fund, and then to some extent let the chips fall where they may. And I think that's kind of Vanguard's approach, right? You guys just want to expose us to the markets, and hopefully over time the markets will have decent returns. But we've lived through 30 or 40 years of abnormally high returns. Right. I mean, if you look at history, the returns, particularly in fixed income, are just completely and totally irregular. So I'm just throwing out to the board, to Brian, Carol, and everybody, just a sort of a question, which is how do we run this fund, given that there's a imperative from the top that we're supposed to figure out a way to make 7%. And then, of course, that leads to the next question, which is, should it be 7%? Right.
Yeah, I was going to bring that up, Ken.
So, well, and I want to correct some misconceptions. Like, we don't take direction from anybody. We've always been in charge of the discount rate for the past, before my time on the board. So for the past 10 years, we've selected that number. There's been
no, Brian, I'm not arguing
how to enter it.
Yeah, I'm talking about the pushback. Yeah.
Right.
No, so I mean, we got to our 7%, and we had an actuarial. We used two different data sources. We looked at Callan's study, and we looked at Hooker and Holcomb's did a similar. They use they use different historical numbers, different assumptions, right? And I'd say Vanguard. Or not Vanguard, I would say that Callan if you remember, we talked a lot about geometric averages, how many decades we look back. So it wasn't just a blind Monte Carlo. It was actually foundationally, it was stochastic based. It was based on history. And when I look at this, I mean, would it be ideal to have a range of returns or a bracketing 7? Yeah, but I mean, this is, and I don't want to throw any shade at Vanguard, but this is, it's a little bit of finger in the air here. So when I look at a discount rate and it's a long term, a 30-year horizon, what we've always done is we watch how trends move over time. And when it becomes apparent that, hey, we're not, we're like 5 years, we're at 7 years, we're consistently, below our target. That's how we moved from, we were at 8.25 several, 5, 6, 7 years. I can remember being at that discount rate. And so as we've moved the needle to 7%, which I would say nationally, yeah, we're probably, as a town or as a pension board, we've always been on the conservative side. Generally have moved to a certain paradigm before everybody else, because I think other places are more politically influenced and, drag their feet or don't want to take the pain that's involved with lowering the discount rate as far as what the contribution effect is. And I would say right now, I believe we're probably in the 33rd percentile or somewhere around there, the third decile, I guess, if you will, as far as where we sit on discount rates, meaning there are like 29% or 30% below us, like more conservative. And I would say there's a ton of them around us. And then actually the rest of the world is still clipping higher discount rates. So you can call them fools or whatever. They're seeing something different we have. Or then again, I'd also say that our portfolio, that's the other thing. It's bad to just blindly look at other portfolio or other people's discount rates, because my experience from sitting at a lot of conferences and listening to what people are invested in, I'm shocked at the amount of equity exposure that's been layered on in the past few years and alternatives. So that talk about stretching for returns, it's alive and well, and it appears to be baked into their discount rate too, because they're like, oh, I'm up to 35% alternatives and our overall equity exposure is 70, 75. Here in the state of Connecticut, there's some, you can go look at the state plan and look at their equity exposure, and it makes me grimace a little bit, but that's, that's how they roll. So, and that's why the numbers are kind of all over.
Yeah. So Brian, just so you,
go ahead, Ken.
Okay. No, I was just going to say, I wasn't actually making a comment on past history. I was talking about how we approach this thing going forward. That's all.
Yeah. So I'm gonna
and I'd say just keep an eyeball on it, and certainly get our new actuary to get their input, and then you guys probably don't have to do anything until the next cycle at a bare minimum. And actually, we're due for an experience study, and it'd be ideal to do it with a new actuary in place. And that's it's definitely going to be part of that discussion. And you got a new consultant too, so you kind of have a little bit of a clean slate or whatever. So it's I'm sorry I'll miss that meeting. I might dial in just for fun's sake, but
you'll have to dial into the one where you can't comment.
So the last point I make here before I want to turn it to another slide that I think will be useful just for context is I don't think any of these portfolios, I think you'd agree, none of them are really reaching for risk. They're all still about a 60-40. It's just how you want to switch to sub-allocations. I think they're all reasonable. I think we would feel comfortable with any of these iterations. I just wanted to put those different ones out, but we would feel comfortable with any of those. The other point is that of where's the trend been in discount rates. I want to have Brian Scott just jump in and talk to this. We've done this for the town of Fairfield, the towns of Fairfield County, and this shouldn't determine your rate, but it is interesting. I'm on page 26 for anyone that can't see my screen. Brian, I'll let you jump in.
Yeah, thanks, Brian. This is something we put together for another client that we work with in Fairfield County. And one aspect that we ascertained is when you look at the 7% discount rate, there's 9 plans that are below 7%, and Fairfield sits at 7% with 3 other towns. And then you have Stanford and Trumbull over that 7% threshold. This is all as of 2019, by the way. We've since moved your allocation up to get you closer to the Weston and Easton to increase the return-seeking assets. I think we've been talking about this. The trend is definitely to reduce the discount rates. Given the valuations, given yields, it may be tough to hit 7% in the future. Last year, Greenwich dropped their discount rate from 2018 to 2019, and it's something we've seen across all of the state plans, just a trend in general. So that we thought this would be useful just to show you where the other towns are currently positioned in Fairfield County.
Because the other variable for any town and why and how, every asset allocation should be unique because each plan is unique. And the other one is what's the funded status? And we've color coded that here on the slide of, just different ranges. You have certain plans that are 100% funded. That might lead to a different asset allocation that, for plans that are less than, let's call it in this case, 90% funded. So this is just for context, as Brian was mentioning.
And we've seen some of the plans that are fully funded 100% or more not have alternatives in their portfolio. So they might have more return-seeking assets than you, but they are public and not private.
So guys, if I could just step in, just trying to follow along here without having the slide deck in front of me. If I heard all of this correctly, Brian from Vanguard, it sounds to me like where you're rounding around here is for us to really think hard about the discount rate and whether or not it's set correctly for our fund. That's point one. And point two is to think, given the Fed's letting us know that rates are going to be low for a really long time, and how that will affect bond yields, you would pull some out of that allocation in order to fund, a step-up level of private equity and private real estate.
Yeah, that's a great summary. And, if we increased private real estate, we would take that from the fixed income. And if we increased the private equity, we would take that from the U.S. and non-U.S. equity. But yeah, that's spot on, Carolyn.
Okay. I would be in favor of kind of learning more about the discount rate, not rushing into that, and making sure that we've gathered all the information that we can. And then regarding the increasing the allocation to real estate and private equity, I'm in favor of doing that. But not having the deck in front of me makes me a little uncomfortable kind of jumping in with both feet. But I'd be curious to know what the rest of the board members have to say about that.
Yes, what this is, Brian, just for a quick moment before anyone else jumps in, I'd love to get the feedback again on the private equity. We think we've covered that a lot, but we can cover it again. The private real estate we haven't got into in any depth, and so I would reserve to dig into that as an asset class, or as far as the solution Vanguard has at a future meeting. But yeah, I'll turn it over to the rest of the committee. I just wanted to jump in with that.
I would be interested. This is Eric Newman. I'd be interested in learning more about the private real estate. I know you mentioned that it's a little bit more liquid. Has quarterly redemptions, and what type of structures, or why can we actually liquidate the whole thing, or is there going to be, you can liquidate so much every quarter on the run rate if you needed to liquidate it. And the other assets within the real estate, what what is the makeup of the real estate allocations?
Mm-hmm.
Is it diversified? Is it
Yeah. So
multifamily, commercial? We get retail in there, the hotels. Well, some of them are in favor currently. Obviously, at some point they're going to be coming back, and others will be shifting around. So
sounds like
yes,
it'd be great to have principal come in.
So I'll hit those at a high level, Eric, is on the real estate or private equity. Say we went to that portfolio D, at 10% private equity, 10% real estate. We still have 80% of the portfolio fully liquid and very easy to redeem, to make monthly, or quarterly payments. And so I wouldn't expect touching either one of those allocations unless they got really out of whack for some reason. So I wouldn't look to draw on either one of those asset classes. Those would be long-term strategic targets, and we would use the 4 other public investment funds to meet any redemptions or pension payments. Not really redemptions; it's just paying pensioners. So plenty of liquidity that we wouldn't have to touch those. On real estate, and it's in the back of the book as just far as what we call a fact sheet, is Vanguard has partnered with, we've done our due diligence on this manager just like on HarborVest or any manager we recommend, is there's a firm called IDR, and they have constructed a passive private real estate fund. And of course, that is music to Vanguard's ears, right? We don't have that solution. And so therefore, instead of trying to pick the best real estate manager, again, like Principal and UBS, JP Morgan, all fine funds, is again, just buy the market. And so they will, and they do invest, across, I think, 21 of the 23 private real estate managers that make up the Odyssey or the private real estate index. And so this is a firm that we've partnered with. They're giving Vanguard a lower fee than other funds, and they partner with some national, this IDR includes some of the biggest pension funds in the US that have invested with them for just that reason. These large state plans got tired of trying to pick 1 or 2 real estate managers. They wanted to own the entire, or as much as they can, of the private real estate market. So we'll get into that in a bigger, deeper dive. But in the appendix is some details about this IDR fund, which stands for Investors Diversified Realty. So think of it as an indexed private real estate fund. Again, quarterly liquidity, it keeps the fees low. I don't know if you've come across them, Eric, in your experience in the markets.
Yeah, so I say it's diversified, which is good. Definitely.
Yes.
Well, that depends on if you like the whole real estate market.
Right.
I personally think there's a ton of idiosyncratic risk that can be managed away through, good managers. It's not the stock market. It's not even the bond market. I'm not a fan of indexing in the bond market. So, I mean, we're in it, and that's because the board chose it, and I'm on my way out, but been around real estate my entire investing career, and I'm sorry, it's not where it should. It's not a marketplace where you can just go, oh, I'm just going to own slivers of all this stuff, and I'm just going to be peachy keen. You'll get a return, but that whole thing about managers don't outperform, just like the same thing in the private equity space. I'm sorry, there's enough ability to do better due diligence and to get into better assets than other people, and that's why you want to be with them. Just look at Brookfield, case in point. I don't, you know, you guys can go study their performance and stuff they get into, and I'll let Scott Pollock at a future date when you guys have principal in and listen to their spiel, listen to the whatever it's called, IDR. But Scott's a fantastic resource to this board, and he can share all his wealth of knowledge from being in the space for longer than me. So anyway, that's just my 2 cents on that whole thing. And we're not here to decide anything about real estate, but I do think that we should vote on whether or not we're going to move our allocation closer to what it used to be, as far as, I just call it as the alternatives versus public markets. So these portfolios A, B, C, and D, and so at least codify that, because a lot of it was around the private equity.
Hey, Brian Vahey, it's Carolyn. I just want to interrupt and ask a question, right? We are not beholden to a Vanguard solution for these allocations, right, on the private side, right? I don't recall that we gave away our ability to either stay with the managers we're with and reinvest more with them, or find others, or am I incorrect there?
No, you're correct. We could have an entire portfolio of our own managers. Vanguard, as a co-fiduciary, would have to put on their hard hats, and if they don't know anything about the manager, you know, hard hats and roll up their sleeves and make sure that they're comfortable as co-fiduciaries with and see things sort of the same way we do. But yeah, you're correct.
And I believe, Brian, from Vanguard, I do believe that the discussion we had around the table in our meetings and our diligence with you suggested that you would be able to work with us in that capacity if we chose to. Is that correct?
To change to our different managers? So
if we wanted to stay with our existing managers in private equity and real estate.
Yeah.
Okay.
Yes, and first of all, yes, with private equity, we don't want to ever take a position to sell it just because we don't know those managers, right? It's a whole different asset class. We wouldn't want to sell and impact the portfolio, because if you sell, you're selling into the secondary market. You take potentially a big haircut, and we wouldn't want to do that to the detriment of the plan. So we're not recommending selling any of the private equity. If we don't increase the private equity over time or at any future meeting, not in the 6 or 12 or 18 months, but that private equity allocation, as we get redemptions, will draw down. It won't be at that 5% target. So the private equity allocation is even a decision, do you want to keep 5%? And even if you want to keep 5%, you're going to have to re-up with a private equity manager. Now, as far as Vanguard's co-fiduciary place in this is that we've done due diligence on the private equity marketplace. We've met with, and you may recall this from other meetings, well over 40 private equity firms, and we came to that solution or that partnership with HarborVest for different reasons. So if we were to increase or recommend a additional allocation to private equity, we wouldn't touch the existing one you have, but the recommendation would be then to invest in that HarborVest fund, because we've done our due diligence on them as a manager, and feel like they would be the best solution forward for our clients.
But we would still have the ability to work with the managers that were there, right?
Yeah, we wouldn't.
And put those dollars toward our existing managers rather than, right? I mean, the way you're presenting it, it makes me feel like essentially you're like, yeah, the position's going to decay as you get redemptions, and you can't put it back with the manager you already have. You're going to have to default to our solution. And I just want to make sure that that is not what you're saying.
Well, Carolyn, we don't have, as far as Mesereau or Lexington, while Vanguard may have interviewed them, we wouldn't be recommending additional capital besides what you're already committed to. So there's still commitments that the town is on with both of those managers, and we should continue with those commitments and not change from that. So but if there was another private equity solution, we wouldn't be recommending Mesereau or Lexington.
Okay, but Brian Vahey brings up a really excellent point that particularly in the private sphere, right, the idiosyncratic risk is such that if you can be with the manager and you're comfortable with a manager may in fact outperform a blended index, especially in markets that lack the liquidity that we see in, say, equities and fixed income. And so it is well within the purview of this board to say we want to increase our allocation to private real estate or private equity, and we want to allocate that capital to the existing managers we have.
Right.
And I recognize that you cannot make that recommendation because of where you are, but that doesn't mean that we are not permitted to make that decision. Okay.
Correct.
Thanks.
Correct. Yes.
Thank you.
Yeah. And we definitely, sorry for any confusion. We definitely agree with you on the private equity side with that idiosyncratic risk, and that's a reason for allocating more to that space. And I think you got to hear from everyone got to hear from HarborVest directly and see their track record, and we think that has been one of the best in the industry, and that there is unique factors in private equity that why there's more perseverance that certain managers that have outperformed in the past continue to outperform in the future. The basis is that it's a business of relationships, and HarborVest has been investing with a lot of general partners for 30 plus years, and therefore there's certain funds that are closed to other private equity investors.
Yeah, I understand. I got it. And I appreciate that. We just have a wide variety of professional expertise around our table, and I just and private equity is not my area of expertise. I mean, public equities is my world. So it's just I think it's helpful to kind of track back sometimes and make this as simple as possible for us.
Thank you.
Okay. Well, I just want to sort of bring us back to the agenda, and I guess we're sort of still in someplace, but I would like I said, we have 4 portfolios before folks right now. It's not, this isn't some radical rejiggering of things. It's really a matter of saying, do we want to stay? Now we've jettisoned a bunch of all alternatives. Do we want to stay in this, as Vanguard calls it, lower risk-seeking portfolio, which was different than what we had before? Or do we want to rejigger it back to what the percentages were prior, just being in reduced types of alternatives, meaning it's just really going to be real estate and private equity. And if people are comfortable with that decision, it helps from a planning perspective going forward, particularly in, as Brian alluded to a couple of times, they need to map out a glide path, just like Callan did for how we would get our private equity exposure from today's 5.8% up to 10%, because it takes, you just can't just go buy a chunk and put it in there. So, it's going to sit in public equities for a while, as he said, and as we get capital calls, it would gradually go in, and the assumption is it would be HarborVest, which is why we listen to HarborVest. We get the massive, from a manager perspective, HarborVest has got that track record. They are one of the bigger, better ones. They have access to their ones, and then the fee schedule that was negotiated, it's so much less than, say, Lexington that we have, that it's almost like 100 basis points in management and base management fee alone. Forget about the carry part, which that's tough to beat, or something we could not access on our own if we were to go and say, no, we're going to pick a totally different manager. So anyway, that's neither here nor there because that's going to be down the road. But it's just really, can we get a decision here on or a motion on to maybe select one of these 4 portfolios so we can lay this to rest? I'll make the motion. I'd like to make a motion that the
Brian,
board.
before you.
Yeah, go on.
Yeah.
Well, you can have discussion after the motion. So I'm just trying to get this thing moving.
Okay.
I'd like to make a motion to shift the current pensions asset allocation to portfolio D, which is still a 60-40 portfolio, but which has an allocation to 20% of alternatives in, 10% being in real estate and 10% being in private equity.
I second it.
Scott
I'm sorry,
Pollock
who seconded it?
It's Eric Newman.
Scott.
Thank you.
Oh, Eric. Sorry.
Eric Caliper?
Now,
Newman.
No, Eric Newman.
Newman.
Now it's open for discussion.
So, can I ask a question?
Yeah, it's open for discussion.
Ryan? No, I know, it's just awkward with the phone. I'm just trying to be polite. So just so I understand, if we didn't make this decision this evening, the assets that roll out of alternatives for the time being are being invested in the public equity markets. Is that a correct understanding of the current situation?
No, actually, we still have a chunk in Wellington. So some are still in the hedge fund, and the ones that came out of Invesco and our commodity guy was Graham or
Gresham. So
Gresham.
Yeah.
Those did go into the public markets. Yeah.
That's correct. Yeah, and I'll just jump in. I'm back on page 9. I don't know if you can see, Ken, but right now there's 30% U.S. equity, 20% non-U.S. equity. Reasons for that is mostly towards a 60-40 blend. We've got 5% 5% in Wellington. That's going to be liquidating by the end of next week. That will go in the beginning of October, the equity piece. So we keep that same risk return profile. And that's what I'm showing here on page 15. So that's where I added 3% to U.S. equity and 2% to non-U.S. equity when those funds become available at the beginning of October.
Right.
So think of on page 15 the current policy post the liquidation of Wellington at the end of this month.
And quite
Right.
frankly,
Okay.
even if we select, like I said, even if we select D, reality is you don't turn on private equity. It's going to be a couple of years before we get to D. We're going to start for just the equity portion. We're going to start at A, and it will gravitate to D as the stuff moves into the private equity. The fixed income, you can flip that switch. I mean, we can take it out of the index and put it in the real estate.
Right. Right.
In a couple months.
Yeah.
What is our
for me?
invested?
Yeah. Go ahead.
I was just trying, what is our invested percentage in private equity today? Is that the 5.8%?
Yes.
Using the most. We just finished our. I mean, per our glide path, which we set up several years ago, like I think 3 years ago, it had us, getting to the 5% under Callan's thing, and we're a little over, but that's because some of the funds aren't harvesting as quickly as they anticipated. We've had some lag in the one Mesero thing. It took a while to get going and all that. But I mean, generally, yeah. So the plan sort of worked. We're within like 80 basis points of where we're supposed to be. So as Brian Binkley said, if we don't do anything, we're gradually going to see it.
We have pretty substantial outstanding commitments, right?
Yeah.
On the Mesero and part of one of the LECs, but we should be seeing a fair amount of. It should turn. I don't know what's going to crest that, but we should see a fair amount of harvesting and return of capital as well.
Yeah, Brian Scott's done some work there. As far as I flipped to page 28. And I don't want to get us off the discussion, but if you did, we do have some slides that has our forecast with your existing managers and, what that would look like, over time. Just quickly on page 29, I'll call this the gray, the taupe, whatever. This is your legacy PE allocation, around 21 million or so. And this is a forecast. It depends on how quickly we get distributions and different capital calls, but this is what the glide path that we would estimate is over the next 10 years, call it. Just looking at the existing portfolio.
So to answer Scott Pollock's
the rainbow
thing, we've already
assumptions for HarborVest. Yeah.
Yeah. So we've already crested on our. So even though we do have outstanding, we've got more that's going to be rolling in, so it's going to go down.
So Brian, can I make a comment? It's Ken. I'm sorry. Go ahead. Mm-hmm.
No, go ahead, Ken.
No, first of all, this is this is very difficult being done the way it's being done. It's nobody's fault, obviously, because of the COVID, but this is very disjointed. It's a fairly important and complex discussion, and we're doing it with phone and flipping around on slides on computers, and Carolyn's in her car and so forth. So I just want to it's nobody's fault, but this is making it to me a little bit more complicated. We're missing out on the normal body language and give and take. My concern is, I'm not ready to commit funds to HarborVest personally. I just don't think we know enough about the HarborVest. You guys just signed up with HarborVest. I know you did a lot of due diligence on them, but you're brand new to them as well. This is I hope the board understands, this is a 17-year lockup of our money. 17 years. And liquidity is like gold. Having liquidity, especially in difficult markets, and to give away that concerns me. I really do think that in December, we're going to have a new board, new leadership. I'm not sure how many seats on the board are going to be turning over. I don't know if anybody knows the answer to that question.
Just
I honestly think that, is that true? Okay.
Just me.
I still think that this decision, and there's no rush on this decision, no rush whatsoever. The money is going into the public markets. The returns in the public markets are very similar. You might argue better, you might argue a little worse than the private market. So a couple of months has no bearing on long-term results for the pension board. And I really think this is a discussion and decision that should be left for the new board in the next few months, when we have the next board that's going to be the group doing this for the next couple of years. So I'm not ready to make a decision to commit any new money to alternative illiquid investments. Not that I'm saying we shouldn't do it or we won't do it. I just don't think it's something that we should be doing right now here at this moment. Did I lose the call? Is everybody there?
Hi,
Hello?
this is Caitlin, and I just wanted to reiterate one thing as well. I don't think this was a voting item on the agenda, so I'm not sure that we should be going off agenda.
That's a good
So
point as
maybe
well.
Ken's point, it makes sense to hold off.
I think we clarified that if we were to be able to anticipate moving around of money on a month-to-month basis when there's market movement, doesn't have to be clarified on the agenda. We've already gone over that. It's not especially because it's within our IPS. We're not even moving outside of our investment policy statement, so it's well within the purview of the board to move money as needed, just like it is to. So in that case, Caitlin, every time we need cash, we need to put a thing on there to say act and redeem money as needed. Like it's a month-to-month activity as the board sees fit to do stuff. And another reason we wouldn't want to put it on there is because we don't want to telegraph to other outside parties about what we're possibly doing within the investment horizon or investment capabilities of the pension.
But doesn't the IPS have all of the percentages broken out?
Yeah, they're
Wouldn't that
ranges.
be changing?
We're still within the ranges.
Having said that, that's all well and good, and it's a good point, Caitlin, but Brian might be right as well. I just want to repeat, I don't know about you guys, I'm talking to the whole board, and I'm not saying I'm anti-HarborVest, I'm pro-HarborVest, I'm anti. I am, I'm pretty experienced in this field, and I'm just not at this point comfortable after basically one meeting with a presentation from HarborVest to be committing, there's 1 million private equity operations out there. And I just don't understand the rush here. The money's going into the public markets. The returns in the public markets, some might argue are better, some might argue are worse. They're pretty similar. And a couple of months will have no bearing whatsoever on the long-term returns on our pension fund. And I just think we need to have a more in-depth discussion and a more holistic discussion about private equity. Now we're being told that private real estate might be an option. There's some information in this presentation about a private real estate fund of some sort. We've got to learn about all this stuff, and we have to digest it and figure out where we're going. This is not something we should be making. I know we're only reiterating to some extent previous allocations, but this is an opportunity for us to reevaluate this thing going forward. And again, I just don't understand the rush. I don't understand it whatsoever.
If I could ask a question, it's going to be of Brian Binkley. This is Jack Mahoney. Brian, at what point do you feel that we need to make a decision on this? I would hate to straddle the new board or a few board members with a reasonably large decision that I think a good number of people are okay to make a decision with today. But, is there a month on the horizon that you're like, hey, you guys really should have this taken care of by then?
No, thanks, Jack. That's a great question. No, I don't see any urgency around any of the decisions. The only one, as far as deadline, there's a deadline for the 2020 HarborVest fund, but that doesn't mean there should be there's no urgency to make a decision because there's a 2021 fund. So no, this was, I don't see any deadline. I don't think you need to think of it that it has to be a deadline on making this decision. Does that help, Jack?
It does.
We can get into HarborVest in 2021. We could get into IDR, or if you re-upped with principal in 2021. There's no deadline that we would miss. The only one, just in transparency, is there's a deadline for the 2020 vintage of the HarborVest fund, which would, the final call is December of this year, but paperwork has to be done well in advance of that. So HarborVest has 2 closings each year. We've already had some investors sign up for the first close. That was paperwork had to be done in August. The next paperwork has to be done by sometime in October or November. I'm missing the date. I don't have any urgency or any deadlines that you have to make. I was painting these portfolios just in light of once we have updated capital market assumptions, I wanted to share those. I wanted to share those in the context of different portfolios that we've discussed in the past.
Okay, thanks.
Brian, Eric Caliper here. Just one question. I don't think we have really got any color on it. What's the overlap between HarborVest and what our current holdings are in Lexington and Mesereau? We really need to get some transparency on that, because if we're buying the same products in HarborVest, then we're not really diversifying and we're not really gaining anything from it.
Yeah, good point. If that was Eric, I think that was one of their takeaways that there was asked of them last time. I could follow up. I think when we had HarborVest on the phone, given what they knew about some of the funds, it didn't think there was much overlap, but I still, realized that that wasn't a specific number that we've come back with, or specifically HarborVest has come back with. So I can certainly put that in the back on to get that number. I think it was, if I'm recalling the conversation, I think there was a question to the committee is that being able to share some of the detail around those investments with HarborVest as well. So if that's not a concern, just sharing some about the fund details of the Mesereau and Lexington funds, I think that would maybe help them complete that analysis. But they were in different segments of the market, not totally. Again, I think it's a very low number was their estimate, but I'll follow up from HarborVest to see if they can give a more concrete number.
Thank you, Brian.
And I'll just make sure that you're going to want to make sure you get Jim Baldwin to look at our LPA or subscriber agreement with Lexington and Mesereau, because there very well could be non-disclosure clauses in there as far as particularly going to disclosing them to another private equity shop.
Yeah.
I don't know if they do or don't exist. I'm just letting everybody know. Make sure you don't do something foolish there.
Yeah, but additionally, Eric, and I think this was the point that was made, is this is a new fund for HarborVest. You're not going into an existing fund. And so the investments that you have with Lexington and Mesereau, those are different vintages from, I'd have to pull up the sheet, from 3 years ago, from 5 years ago, I think even from 7 years ago. So there shouldn't be any overlap or very little, given that those investments with your existing private equity managers was made years ago, and HarborVest is all going forward.
Sorry, Brian. Brian, sorry. Whoever's typing, please mute your phone. Thank you. Sorry, Brian, you go ahead.
Now, does that make sense, Eric? Is the investments that you have with Mesereau and Lexington, those were made 3, 5, 7 years ago. The HarborVest fund is a new fund. They're putting new capital work with different general partners. So even from that context, while they might be an overlap from they both invest in secondaries, they should not be the same investments, given it's a new fund versus old funds.
Yes, thank you. I understand that.
They're also making some co-investments, so they're making direct investments. Part of the portfolio is going to be invested directly into direct portfolio companies. Another portion is going to be the secondaries. So even though one of the legacy funds might end up selling, let's say, a position, they're liquidating. with the secondary market, the new fund would be buying from a previous private equity firm that's exiting a portfolio of a sort. So, but it's rare. It's probably going to be very highly unlikely they're going to end up selling to them, because there's so many private equity funds out there, and if they got a piece, they got a piece because it was probably valued at the right price, and
Right.
And then the third part is just the new investments. So.
Right. Yeah, just using ballpark figures, primary investments around 60% of the portfolio, maybe 20 to 30% in secondary, and 10% or so in co-invest. And so it is a very diversified portfolio by different types of private equity.
Okay, so I'm sensing that there's not a whole lot of desire to move to vote on this tonight. So I'll rescind my motion, and we'll move on in the agenda, which is CFO report.
I'm going to try to stop sharing here.
This is Caitlin. So this activity reflects the month of August and current up through basically today. Clearly, the pensioner payments were made on August 1st, like they are of the first of every month. About $2.2 million went out in pensioner payments on August 1st. On August 20th, the town made the last half of the employer contribution for fiscal 21 of approximately $6 million. 2.9 of that went to the town and 3.1 went to police and fire. So the net of those, the payments going out and the contribution coming in was about $3.8 million, was invested actually the next day per a direction from Vanguard. So I've been working closely with Brian Scott and Brian Binkley to ensure that we are not out of the market at all. So we go ahead and we made trade tickets. So they were invested, and I believe Brian Binkley can correct me if I'm wrong, in the international and U.S. bond markets within Vanguard. Late August, there were some dividends and some capital calls from Mesereau and Lexington, nothing greater than like $200,000. Some dividends came in, and a capital call of 180 went out to Mesereau on August 27th, which brings us to September 1st. Again, pensioner payments of about 2.2 went out. And subsequently, we invested any idle funds that went to, I believe, fixed income within the Vanguard portfolio as well. As Brian Binkley alluded to, we will have some activity come September 30th or so with the redemption of Wellington. But other than that, that's been about the activity running through the funds accounts for August and September.
Thank you. Any questions?
You're welcome.
All right, next item is old business, and this isn't really old business, but Caitlin, you weren't on. We were, it's not a vote, it was just speaking on number 3 on the agenda, the RFP follow-up. The brief that we got from Carolyn was that it wasn't completed yet, but there was a deadline date for it to be completed. I think that might be Carolyn unmuting her phone.
Yeah, do you want me to do it?
Yeah.
Sorry, I have unmuted. Can you hear me? The update I
Yep,
gave
we can hear you.
Caitlin was that we had met by phone over the summer. We had at least one conversation, followed up with emails with the hope of seeing an initial draft for this meeting, but we will be seeing the initial draft of the RFP at the next meeting, and we have a firm kind of target date of going out with the RFP at the very end of December, early January. And
Yeah,
I tried
so
my
we had
best to
hoped-
explain the timing. Yeah, that's going to be you to help explain the timing decision.
Okay. So I'll take it from here. But yeah, so we had hoped to get a draft to at Lisa, Carolyn, and maybe Ken and Brian for this meeting. There was some illnesses and a few delays. Gerald is still hoping to get a draft next week to at least you guys, if you guys wanted to just take a look at it. I don't know if you want the whole board to review it prior to actually being issued or not. So again, we had a phone conversation with Carolyn. There was a few questions on terms of in the scope, how we wanted to word, how many meetings a year. I mean, some pretty, what type of analysis we need, what type of services are going to provide. So Gerald has been working on that. I know he's been using the state RFP that I think, Brian, you sent, and I believe he found he was using the city of Norwalk as well, as he was involved with creating that when he actually worked in Norwalk. So that's where we are with that. In terms of the timing, we really wrestled with this. And so basically what's going on right now is there's census data being provided to Hooker and Holcomb for they need to provide information for GASB requirements for our annual report. They need to provide that to our auditors in November. So they're currently working on that, in addition to now switching over to creating an ADAC for the budget process. The budget process, we need an ADAC number. Ideally, we start the budget process in November. So we have clearly an estimated ADAC from the last valuation on the pension, given the new mortality table. We do not have any type of ADAC on the OPEB side with the new mortality tables, given the timing of the OPEB valuation being every 2 years. So given that information, given the RFP, once it's issued, there's a 4-week window that any provider has to respond to the RFP. So let's just say that that's going to be about a month. In talking to a few of my contemporaries who work at actuary firms, the basic time frame to do an ADAC calculation is 8 weeks after they receive the data. The data now I just received from people today, the pension data for June, and I believe the OPEB data is actually complete. So given the 4-week window of the RFP, the 8-week time to create the ADAC, given the budget cycle starting in November, to put an ADAC into the selectmen's proposed budget, and then meeting with the Board of Finance in March, it was really going to be an effective July 1, we think, new service provider.
So the part of the conversation you missed is, and I'm leaving, but I mean, I seemed like it was pretty much consensus of the rest of the board. We're not comfortable with the current actuary provider, and we don't want to use it anymore for any sort of ADAC calculations, because that's how we got the discussion we're having today. So, which actuary folks were you speaking to that gave you these kind of numbers about how long it takes?
I know people from the GFOA organization who I'm just friendly with. So it was hey, how long does it take an ADAC calculation? They said, well, the first time is clearly the longest. So if it's a new service provider, it takes even longer than if you've done it previous year. So that was an estimation from 2 different people that I talked to.
The GFOA is not an actuarial society. It's the governance. It's a government finance officer association, right?
It is, and there's clearly people in the whole industry who go to these meetings. But I'm just saying, given the time frames, I'm not sure there's time to get new ADEC numbers for this budget cycle, given a 4-week window of once the RFP is issued.
I think you need to get that RFP issued next week, and no, the board doesn't need to look at the RFP before it goes out because they're more interested in seeing the candidates that reply.
Okay. I'll
And
let Gerald know.
I'll tell you that since you've got a more, an accounting background, I can tell you that there's working papers and there's precedent. So it's not like you're, walking in to some unknown. So some of the hardest things for doing an actuarial calculation is understanding what sort of smoothing assumptions you're making, what are your discount rates, what's the attribution of your pension, your current retiree population versus your actives, and whether you're using what kind of pay methods you're using, and we have those all quantified, and we wouldn't be changing those. So if those are all done, it's not going to take 8 weeks to do a calculation. Just
okay. Well, that's what two people in the industry told me, and I believe they're still gathering census data as well. But I'm just telling you information. I mean, I understand you don't like the time frames. Even if we get it out, let's just say next week, it's going to be close. I don't know. I don't feel comfortable just plugging a number into the budget. We have nothing on the OPEB side in terms of ADEC, but there's going to be a new CFO here.
So you'll just have to make the Board of Finance aware of the situation that we're in, and I think they'll understand completely.
The various bodies have made adjustments throughout the budget process based on more current information that comes along. The first bite of the first select person, is an early on budget. The same with on the other side of the Board of Ed. But as the process goes along, you have a several-month process, and new data comes out, and we're going to be making adjustments. So, over time.
I agree, but I believe in this case it's more than an adjustment due to the fact that with the new mortality table on the OPEB side. I don't think we have a baseline number for that.
Well, we have the historical data, and the town is going to be preparing data for the current actuary, as well as you provide the data. So the new one would just get the same data, and they would run with it. They already have models built, and they're doing it with the, whoever the next actuary is. We have this already built. We're not going with like a first-time actuary startup. It's going to be a big company. Have done many clients, and they already have a lot of the legwork already built in their models. So it's just a matter of, they want the business. They know there's going to be a tight deadline, and they're going to let's see what they present to us.
I mean, we can, and again, it could go out next week, and we have a 4-week window, and we can see where we are then. I don't know. I don't feel comfortable not having the OPEB number, but again, there's going to be a new CFO in the seat in 10 days, so.
Yeah, that's great, and thank you, Caitlin. And I think we can just move along at the timeline we're on, and I appreciate all the work everybody's done to get us put together in a fashion. And thank you, Carolyn, for helping facilitate that. I think for any new business?
I think we should just acknowledge. I think we should just acknowledge that this was Caitlin's last meeting with us.
Oh.
We have a new CFO starting next week.
So, Caitlin, are you staying in a controller role, or what?
Yes, I am headed back to my old hat.
Keeping the CFO out of trouble.
So a Mr. Jared Schmidt will be starting on October 1st.
Hey, I didn't see any announcement. Is he a CPA?
I don't recall recall. I don't know.
I didn't see that in the press release. Has he been a CFO before?
No, I don't think he's been a CFO.
Yeah, I didn't see that either. All right, just curious. That's great. We'll have to introduce him to all the stuff on our website to get him up to date on the materials and stuff. And Caitlin, I think you've done a tremendous job stepping into a void, and transition assets to a new manager. I really appreciate everything you've done.
Yes, it was a very busy 9 months for the town and for the board. So.
Yeah. And I can also say that even when Bob was the CFO, Caitlin was very helpful. Because Bob didn't cover all the Caitlin has been helpful for much longer than the past 9 months. So thank you, and I'm sure you will continue in the future.
I can
Brian.
second that. This is Ken. Thank you very much, Caitlin.
Thank you, Ken.
Caitlin, thank you for everything. Don't be a stranger.
Oh, I know. These meetings are so exciting. I'm gonna listen in.
Clearly, you know how to have a good time.
I too, Caitlin.
Touche on that last one. I acknowledge that completely, and so it might be a fantastic segue to. Can I get a motion to adjourn?
Oh, I would like to make the motion to adjourn.
Caitlin makes the motion to adjourn. I think Tom McCarthy seconded it. So all in favor?
Aye.
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 All right.
Bye.
Everyone have a great rest of the evening. Thank you so much.
Good night. Bye.
You too, Brian.
Thank you, everybody.
Bye, everybody.
Take care.
Good night.
And it's the Joint Retirement Board Commission meeting.